Financial statements are important documents that provide valuable information about a company's financial performance and health. Understanding financial statements is essential for making informed investment decisions, analyzing a company's creditworthiness, and evaluating its financial position. Financial statements are reports that summarize a company's financial transactions and activities over a specific period, typically a quarter or a year. They include three primary documents: the balance sheet, the income statement, and the cash flow statement. These statements provide information about a company's assets, liabilities, equity, revenues, expenses, cash flow, and financial ratios. Financial statements are important because they help investors and analysts assess a company's financial health and potential for growth. Investors use financial statements to make informed decisions about whether to invest in a company's stocks or bonds. Financial statements are also useful for lenders who want to evaluate a company's creditworthiness before extending credit. In summary, understanding financial statements is crucial for anyone who wants to make informed investment decisions, assess a company's creditworthiness, or evaluate its financial position. By analyzing financial statements, investors and analysts can gain valuable insights into a company's performance and make informed decisions about its future prospects. There are three main types of financial statements that provide important information about a company's financial health: the balance sheet, the income statement, and the cash flow statement. 1. Balance sheet. The balance sheet is a snapshot of a company's financial position at a specific point in time. 1. It shows what a company owns, assets, what it owes, liabilities, and what is left over for the owners, equity. 1. The balance sheet equation is assets equals liabilities plus equity. The balance sheet is important because it provides insight into a company's liquidity, or its ability to meet its financial obligations in the short term. By comparing a company's current assets to its current liabilities, investors can determine whether the company is able to pay its debts as they come due. 1. Income statement. The income statement is a report that shows a company's revenues, expenses, and net income over a specific period of time. 1. It shows how much money the company made and how much it spent during the period, as well as the resulting profit or loss. The income statement is important because it provides insight into a company's profitability. By comparing a company's revenues to its expenses, investors can determine whether the company is generating a profit or a loss. The income statement can also help investors assess a company's ability to generate earnings in the future. 1. Cash flow statement. The cash flow statement is a report that shows the inflow and outflow of cash in a company over a specific period of time. 1. It shows where a company's cash is coming from, cash inflows, and where it is going, cash outflows. The cash flow statement is important because it provides insight into a company's liquidity, or its ability to pay its bills in the long term. By analyzing a company's cash flow, investors can determine whether the company is generating enough cash to fund its operations and investments. In summary, the balance sheet, income statement, and cash flow statement provide different types of information about a company's financial health. By analyzing these statements, investors can gain a better understanding of a company's financial position, profitability, and ability to meet its financial obligations. The balance sheet is one of the three primary financial statements that show a company's financial position at a specific point in time. It provides a snapshot of what a company owns, assets, what it owes, liabilities, and what is left over for the owners, equity. Definition and purpose of a balance sheet. The balance sheet is a financial statement that reports a company's assets, liabilities, and equity at a specific point in time. The purpose of the balance sheet is to provide investors and analysts with a snapshot of a company's financial position, including its liquidity, solvency, and financial flexibility. Explanation of the different components of a balance sheet: assets, liabilities, and equity. The balance sheet is divided into three main components: assets, liabilities, and equity. 1. Assets. Assets are resources that a company owns or controls and that have future economic value. 1. Examples of assets include cash, accounts receivable, inventory, property, plant, and equipment, and intangible assets such as patents, trademarks, and copyrights. 2. Liabilities. Liabilities are obligations that a company owes to others, such as suppliers, lenders, and employees. 2. Examples of liabilities include accounts payable, loans, notes payable, and salaries payable. 3. Equity. Equity represents the residual interest in the assets of a company after all liabilities are paid. 3. It includes the common stock and retained earnings of the company. Examples of how a balance sheet can be used to evaluate a company's financial health. The balance sheet is an essential tool for evaluating a company's financial health. Here are a few examples of how the balance sheet can be used. 1. Liquidity. The balance sheet can be used to assess a company's liquidity, or its ability to meet its short-term obligations. 1. This can be done by comparing a company's current assets, such as cash and accounts receivable, to its current liabilities, such as accounts payable and short-term debt. 1. A higher current ratio, current assets divided by current liabilities, indicates a company is more liquid and better able to meet its short-term obligations. 2. Solvency. The balance sheet can also be used to assess a company's solvency, or its ability to meet its long-term obligations. 2. This can be done by comparing a company's total assets to its total liabilities. 2. If a company's liabilities exceed its assets, it may be in financial distress and may have trouble meeting its long-term obligations. 3. Financial flexibility. The balance sheet can also provide insight into a company's financial flexibility, or its ability to raise capital and invest in new projects. 3. This can be assessed by looking at a company's equity, which represents the residual interest of the owners in the company's assets. 3. The higher level of equity indicates that the company has more financial flexibility and is better able to invest in new projects and initiatives. In summary, the balance sheet is a crucial financial statement that provides valuable information about a company's financial position. By analyzing the components of the balance sheet, investors and analysts can assess a company's liquidity, solvency, and financial flexibility, and make informed investment decisions. The income statement is one of the three primary financial statements that reports a company's financial performance over a specific period. It shows a company's revenue, expenses, and net income, or loss, for the period. Definition and purpose of an income statement. The income statement, also known as the profit and loss statement, is a financial statement that reports a company's revenues, expenses, and net income, or loss, for a specific period. The purpose of the income statement is to provide investors and analysts with information about a company's financial performance, including its revenue generation, cost management, and profitability. Explanation of the different components of an income statement: revenues, expenses, and net income. The income statement is divided into three main components: revenues, expenses, and net income. 1. Revenues. Revenues represent the income generated by a company from its core operations. 1. This includes revenue from the sale of goods or services, as well as any other income generated from non-core operations. 2. Expenses. Expenses represent the costs incurred by a company in generating its revenue. 2. This includes the cost of goods sold, salaries and wages, rent, utilities, and other operating expenses. 3. Net income. Net income represents the profit, or loss, generated by a company after all expenses have been deducted from its revenue. 3. A positive net income indicates that the company is profitable, while a negative net income indicates that the company has incurred a loss. Examples of how an income statement can be used to evaluate a company's profitability. The income statement is a critical tool for evaluating a company's profitability. Here are a few examples of how the income statement can be used. One. Gross margin. The gross margin is a measure of a company's profitability before overhead costs are considered. 1. It is calculated by subtracting the cost of goods sold from revenues and then dividing by revenues. 1. The higher gross margin indicates that a company is generating more revenue from each sale and is operating more efficiently. 2. Operating margin. The operating margin is a measure of a company's profitability after overhead costs are considered. 2. It is calculated by dividing operating income, revenues minus operating expenses, by revenues. 2. The higher operating margin indicates that a company is able to generate more profit from its core operations. 3. Net income. Net income is a measure of a company's overall profitability. 3. The higher net income indicates that a company is generating more profit, while a negative net income indicates that a company is operating at a loss. In summary, the income statement is an important financial statement that provides valuable information about a company's financial performance. By analyzing the components of the income statement, investors and analysts can assess a company's revenue generation, cost management, and profitability, and make informed investment decisions. The cash flow statement is one of the three primary financial statements that reports a company's cash inflows and outflows over a specific period. It shows how a company generates and uses its cash, and is critical for assessing a company's liquidity. Definition and purpose of a cash flow statement. The cash flow statement is a financial statement that reports a company's cash inflows and outflows over a specific period. The purpose of the cash flow statement is to provide investors and analysts with information about a company's ability to generate cash and meet its obligations. Explanation of the different components of a cash flow statement: operating, investing, and financing activities. The cash flow statement is divided into three main components: operating activities, investing activities, and financing activities. 1. Operating activities. Operating activities represent the cash inflows and outflows generated from a company's core business operations. 1. This includes cash received from customers, payments to suppliers and employees, and other operating expenses. 2. Investing activities. Investing activities represent the cash inflows and outflows generated from a company's investments in long-term assets. 2. This includes the purchase or sale of property, plant, and equipment, as well as investments in securities and other long-term assets. 3. Financing activities. Financing activities represent the cash inflows and outflows generated from a company's financing activities. 3. This includes the issuance or repayment of debt, as well as the issuance or repurchase of stock. Examples of how a cash flow statement can be used to evaluate a company's liquidity. The cash flow statement is a critical tool for evaluating a company's liquidity, or its ability to meet its short-term obligations. Here are a few examples of how the cash flow statement can be used. 1. Free cash flow. Free cash flow is a measure of a company's ability to generate cash after accounting for capital expenditures. 1. It is calculated by subtracting capital expenditures from operating cash flow. 1. The higher free cash flow indicates that a company is generating more cash than it is using, and has more flexibility to meet its obligations. 2. Cash conversion cycle. The cash conversion cycle is a measure of how quickly a company can convert its inventory into cash. 2. It is calculated by adding the number of days it takes a company to sell its inventory to the number of days it takes to collect payment from customers, and subtracting the number of days it takes to pay suppliers. 2. A shorter cash conversion cycle indicates that a company is able to generate cash more quickly, and has more liquidity. 3. Net change in cash. The net change in cash represents the difference between the beginning and ending cash balances on the cash flow statement. 3. A positive net change in cash indicates that a company generated more cash than it used, while a negative net change in cash indicates that a company used more cash than it generated. 3. A positive net change in cash is generally seen as a positive sign for a company's liquidity. In summary, the cash flow statement is an important financial statement that provides valuable information about a company's ability to generate cash and meet its obligations. By analyzing the components of the cash flow statement, investors and analysts can assess a company's liquidity and make informed investment decisions. Financial ratios are used to analyze a company's financial performance and help investors and analysts make informed decisions about whether to invest in the company. There are several types of financial ratios that are commonly used, including liquidity ratios, solvency ratios, and profitability ratios. Explanation of key financial ratios. 1. Liquidity ratios. Liquidity ratios are used to measure a company's ability to meet its short-term obligations. 1. Examples of liquidity ratios include the current ratio, current assets divided by current liabilities, and the quick ratio, current assets minus inventory divided by current liabilities. 2. Solvency ratios. Solvency ratios are used to measure a company's ability to meet its long-term obligations. 2. Examples of solvency ratios include the debt-to-equity ratio, total debt divided by total equity, and the interest coverage ratio, earnings before interest and taxes divided by interest expense. 3. Profitability ratios. Profitability ratios are used to measure a company's ability to generate profits. 3. Examples of profitability ratios include the gross profit margin, gross profit divided by revenue, the net profit margin, net income divided by revenue, and the return on equity, net income divided by total equity. Examples of how financial ratios can be used to evaluate a company's financial performance. 1. Liquidity. If a company has a current ratio of less than 1, it may not be able to meet its short-term obligations. 1. If a company has a quick ratio of less than 1, it may have difficulty meeting its short-term obligations without selling inventory. 2. Solvency. If a company has a high debt-to-equity ratio, it may be highly leveraged and have difficulty meeting its long-term obligations. 2. If a company has a low interest coverage ratio, it may have difficulty paying interest on its debt. 3. Profitability. If a company has a high gross profit margin, it may be able to generate a high profit on its sales. 3. If a company has a high net profit margin, it may be able to generate a high profit after all expenses are taken into account. 3. If a company has a high return on equity, it may be generating a high return for its shareholders. In summary, financial ratios are a valuable tool for analyzing a company's financial performance. By understanding and analyzing key financial ratios, investors and analysts can make informed decisions about whether to invest in a company. In conclusion, understanding financial statements is essential for making informed financial decisions. Financial statements provide a snapshot of a company's financial performance and position, and by analyzing them, investors and analysts can evaluate a company's strengths, weaknesses, opportunities, and threats. To recap, financial statements include the balance sheet, income statement, and cash flow statement, which all provide valuable information about a company's financial health. By examining the different components of these statements, such as assets, liabilities, revenues, expenses, and net income, investors and analysts can gain insight into a company's profitability, liquidity, and solvency. Financial ratios are another valuable tool for analyzing a company's financial performance. By calculating and comparing liquidity ratios, solvency ratios, and profitability ratios, investors and analysts can gain a deeper understanding of a company's financial health and make informed decisions about whether to invest in the company. In conclusion, understanding financial statements and financial ratios is essential for making informed financial decisions. By analyzing financial statements, investors and analysts can evaluate a company's financial health and make informed decisions about whether to invest in the company.